All the financial instruments will be impacted by economic events more or less, and on some of the event dates, there are very good trading opportunities. However, even for the same financial instrument on the same event date, there are different trading scenarios. So in this video, I'm going to show you some examples on trading Forex on the interest rate decision date, and then the scenario is called lagged movement. Let's get started. I'm going to use January 26th, 2022 for example. On that day, we have two events. The first one is the Canadian interest rate decision at 10 o'clock, and the other is the US interest rate decision at 2 o'clock in the afternoon. So we'll focus mainly on the US interest rate decision. Normally, after the result is released, there are a few scenarios. The first scenario is the market will react to the result immediately. There are big movements that you can observe. The second scenario is the lagged movement, that the market did not react to the financial result right away, however, it moves later on. So this is the scenario we are going to talk about in this video. The third scenario is there's no movement on that day after the financial result is released because the market already took in the forecast into the price already, maybe in the previous days. There are so many currency pairs out there, and which one to choose, because you cannot trade two or three at the same time. You should focus on one. So there are a few criteria. The first one is choose the most volatile one based on your historical study. So basically for GBP USD, normally the daily range is roughly 80 to 90 pips. For USD CAD, it could be roughly 80 to 90 pips. And for Euro, it will be a little bit lower, like 50 pips. So you want to choose the most volatile one. The second criteria is choose the one that you are most familiar with, because a lot of traders will focus on maybe a few currency pairs and ignore the rest. So choose the one you are most comfortable in trading with. The third criteria is to base on that day's chart that you can see which currency has the setup that gives the highest probability. This is the 5-minute chart for Euro and US dollar. So we can see that this is the London Open. Right after the London Open, the market just bouncing back from between PP and also this yellow level. So this level is formed by the market. It's not the natural level. And you can see that it never reached the support 1 and also the previous day's low. So there's nothing particular for the trading range for Euro. This is the 5-minute chart for GBP US dollar, and we can see that after the London Open, the market is bouncing back between the previous day's high, this dotted line, and also with this orange level. It reached PP previously upon the open, and it's far away from support 1. So there's also nothing particular for this GBP. This is the US dollar CAD 5-minute chart. We can see that after the open, the market goes down from PP level to S1 and previous day's low, and also to test the S2, but it failed. And after that, at 10 o'clock, there is a Canadian interest rate decision. So you can see that it's popping up to test the PP. So before the US interest rate decision, it's in the trading range. So in terms of the probability of the economic event of the US interest rate event on this currency pair, the probability will be lower. Even though later on it might not be the case, but right before the interest rate decision at 2 p.m., so we will say that the probability is low. So we want to ignore this. So right after the result is released at 2 p.m., you can see that the bars are not very big, and then generally the market is still within the trading range. So what we want to do is just to sit tight and then watch the market. And then after that, we can see that here's a big trend bar. This bear bar is a very big trend bar. The reason that this bear bar is a trend bar is because take a look at the body. The body is larger than any of the bars on its left. Though that this bar has a very big tail, but it doesn't really count for the tail. So this is a trend bar. Trend bar means the direction of the market. Normally on the event dates, when the market starts to move, the 5-minute chart bar will be too big. And you want to capture the market move as early as possible. So we can get down to 1-minute chart or even 30-second chart. And then if you use the 1-minute chart, you can see that the market breaks down here, breaks the previous level. Previously, the market is moving within the trading range between the previous day's high and also this orange level. Right now, it breaks the level and then pulls back. So you can trade the pullback. And then after the pullback, you can see that this bear bar is a very good signal bar because the body leaning towards the bottom of the bar. And then you can put your sell order under the bottom of this bear bar to get into the market. And then what you can see is that based on the waves, so the first wave is from here to here, and then we have a pullback, and then you can expect the second wave from here to here, roughly the measure move. So this is how you trade this short opportunity. After you enter the market, so you can scalp or swing. So if you scalp, you should get out of your position before this leg ends, because either based on the measure move or based on the your profit target. If you choose to swing, you have to wait for the pullback. So here, there's a bull bar here. This is not a pullback. How you decide whether it is a real pullback or not, you can do something like this. So this is the first leg, and then we have a pullback like this. So you want to expect the pullbacks of the similar distance. So that's why when you check here, so when you see the market goes up to test this PP level, you know this is the real pullback. When the market goes back downward again, so you know that there's another good opportunity. So in case you choose to scalp, you get out of your position. So when you see this pullback and this signal bear bar, very good bear bar, you want to re-enter the market by putting your short order below the bear bar here to enter the market. So you can expect the another third leg here. You can see that this is the third leg, and then your profit target should be the support one here, level here. When it hit it or even before it, you should take the profit. Don't let it go below it, because probably the market can reverse back, and then also this is a third leg already. The probability for the fourth leg will be low, so you want to get out of your position as soon as possible before the it reaches the S1 here. And so if you choose to swing, the same thing. You don't want to wait until the market to go back to test your previous lower high here. That's too much. So probably you also want to get out here. So this is how we trade the interest rate decision for the Forex, for the scenario that lagged movement because the market didn't react to the interest rate decision right away upon 2 o'clock, but it moves later on. So if you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you.